go to the management of Suzlon and come back to you. That's the first management on the show. The company reported a strong top-line performance, actually, but margins were a little bit lower. The mix, in fact, seems to have changed a little bit. To understand what went on in the past quarter and, more importantly, execution for the second half of the year, Mr. Himanshu Mody, the CFO of the company, joins us. Hi, Himanshu. Good morning, and thanks a lot for joining in, as always. When I'm looking at, the deliverables, in the first half of the year, you've delivered roughly around 530 megawatt. That's, an approximate number. For the year, I think most on the street were working with 1.5 gigawatt odd. My question to you is, how much of your year's deliverables have you done in the first half of the year? And I believe the second half of the year will be much heavier. So how much is due?
So, hi, good morning to you all. So again, if we look at our trends in H1, typically we've always done close to about 35% of deliveries, and H2 accounts for the balance 65%. So by that token, if you look at it, we are inching close to anywhere between 1.3 to 1.5 gigawatts for the annual delivery plan.
Mathematically, it should be 1.5 to 1.6.
Yeah, well, I wish it works. It's 35%, but yeah, we are obviously working towards the best targets possible.
Got it. Okay. All right. So that's on the execution front. What about margins? It seems to be a couple of one-offs like the ESOP cost and a couple of other costs that hurt in the past quarter, and that's why margins did compress. But what's the margin guidance for the year? I think earlier when we were chatting, I think you were talking about around 16, 17% margin, 17 to 18% margins. That would mean second half of the year will have to be far better. Do you hold on to that guidance for the year, 17 to 18% on an average for the year?
Let me rectify that. You need to look at our segmental performances because the company has two large segments, as you're aware. One is the WT manufacturing division, and the other is the services division. When you look at the consolidated margin, the consolidated EBITDA margins are bound to reduce in terms of percentage terms as the WTG business increases in size in the overall segment, because that's a single-digit margin business for us as compared to the services business, which is close to about 40%. The guidance that we'd spoken earlier on the 17 to 18% that you're talking about is with regards to the gross margin or the contribution margin for the WTG business standalone basis, which this quarter has been about 21.8%. So we maintain that it'll be in the late teens, early 20s gross margin on the WTG business. But if you look at the consolidated EBITDA margin for both segments put together, then naturally, because of the WTG increasing its share in the overall pie, the console margins on the EBITDA level are bound to reduce.
So what should it be? What should it be then? You've given us the breakup. As you said, O&M is higher margin business, WTG is lower, WTG's share is going up. So what should we work with? Give and take everything on a blended EBITDA margin, what should it be?
So I think, our WTG business will be high single digits in terms of EBITDA margins. And the OMS business will be close to about 40%, as is always the case. So I would say, early teens in terms of operating margins at a console level is what one should be looking at.
Morning, Prashant here. Sorry, on EBITDA, could you just repeat that, please? What's the guidance, EBITDA margin?
So I don't want to give any guidance, Prashant, but again, I'm saying that, on the WTG business, we've always had high single-digit margins in terms of EBITDA level and 40% at the OMS level. So if you look at it on a blended basis, it'll be in the low teens in terms of EBITDA margin at a console EBITDA level.
Okay. What about order book, Himanshu? What is the accretion you've seen? What is the outstanding order book at? And could you give us a sense of where that will move up to or in H2 by the end of H2?
So we're currently at about 5.1 gigawatts. Of course, we secured the largest wind order in the country in Q2 from NTPC. That was close to about little less than 1.2 gigawatts. We have a very active pipeline, and I know whenever we've met, we've always said that this is the highest ever order book that the company's had on a quarter-on-quarter basis. And I think, we'll continue to say that for a few quarters because the order pipeline is quite active available with us. So whilst I can't put a precise number on where we will be at the end of the year, but rest assured, I think there is a very large pipeline available for the company. And the current 3.1 gigawatt. The execution timeline for that is close to about 2 years.
Just some sense on, the kind of bid pipeline that you will be sort of adding to by the end of the year, and also some idea of, the competitive intensity, what's really happening in auctions, how are prices moving, and, what can we expect in terms of adding to the order book? If you could give us some rough estimates.
So, as I said, I mean, very difficult for me to put a number on what we'll be adding to the order book. But if you look at the industry in terms of, bids or C&I customers, order pipeline available out there, it is, 10 gigawatts plus. So, whilst there is some competitive intensity, but I think there is room for all of us to play in that market because, all of us put together as OEMs will need to be able to deliver upon that demand that's coming from all our consumers, from our customers.
Okay. Just a word on Renom as well. We spoke about it on the last call when the acquisition happened. So how is that progressing along, and by when does, everything get integrated and start reflecting in the numbers?
So for the Q2, it has started reflecting. I mean, we started consolidating for about 25 days of Q2. You'll see is reflected in our Q2 numbers. So, of course, Q3 of this year would be a full quarterly consolidation of Renom. And we'll continue to operate it as a separate subsidiary, separate management, focusing on growing the multi-brand O&M segment. So whilst realize whatever synergies at the back end, but there is no intention of integrating the management as yet.
Just a quick question, Himanshu, on the blended margins, since FY26, the WTG segment could contribute even more. You hold on to early teens, or is there a risk that it goes into high single digits, the blended margins?
So very difficult for me to give any FY26 guidance. But as I said, I mean, it all depends. It's a function of how much deliveries we're able to do in FY25 and FY26. Because what you need to realize is the O&M business will, of course, grow, gradually at an inflation or as and when we keep adding it to our kitty. But the WTG business will, of course, definitely grow more rapidly than the O&M business would.
All right, Himanshu, we'll leave it there. Thank you very much for your time. Appreciate it here on CNBC TV18. And good luck. We'll speak again. We'll take a happy Dhanteras and season's greetings from all of us here to everyone at Suzlon. Thank you. We'll take a break. Mitesh and